Hello and welcome. Today, we're diving into the Indian Rupee's record-breaking fall. Now, depending on who you ask, this is either a brilliant strategic masterstroke for the economy, or it's a huge flashing warning sign. So our job today is to break down what's really going on.
So, let's set the scene. The rupee recently hit an all-time low against the US dollar. It crossed that big psychological barrier of 90 rupees to $1. And it's not just a one-off thing. It's now being talked about as one of Asia's worst-performing major currencies.
So you've got two completely different takes here. On one side, you have officials calling this a masterstroke. On the other, a pretty critical analysis is arguing that this slide is actually exposing some major cracks in the economic story we're being told. So which one is it? Let's get into it.
To really get what's going on, you first have to understand that there are two completely opposite stories being told about what a falling currency even means.
And this is where it gets really interesting. Just look at the change in tone. Before 2014, a falling rupee was painted as this massive crisis, a sign of a government failing. But fast forward to today, and the official line is way calmer. Basically, don't worry about it, this is normal. It's this complete 180-degree turn in perspective that's at the heart of this whole debate. So, the official story, the masterstroke argument, goes something like this. A cheaper rupee makes Indian products less expensive for other countries to buy. In theory, that should boost our exports, bring in more money, and maybe even create jobs. It's presented as a smart way to navigate tricky global stuff like US tariffs.
But the analysis we're digging into today, it says not so fast. In fact, it argues that this falling rupee doesn't prove the strategy is working. It actually pulls back the curtain on three major myths about the Indian economy.
And the first thing it takes aim at are those celebrated GDP growth numbers that have been making headlines everywhere.
Okay, quick explainer before we dive into the numbers. Real GDP. You hear this term all the time. It's supposed to be the real measure of economic growth because it takes out the effect of rising prices or inflation. It's meant to show if we're actually producing more stuff, not just that stuff costs more.
And the number that's been front and center is a huge 8.2% real GDP growth. I mean, that's a number that paints a picture of India as the fastest growing major economy in the world. It sounds amazing. But here's the catch that the analysis points out. You see that tiny little gap between nominal GDP, that's the one with inflation, and the real GDP? It's unusually small. Why? Because the reported inflation used in the calculation was just 0.25%. The argument is, if you're adjusting for almost zero inflation, are you really adjusting for anything? It could be making that real growth number look bigger than it actually is.
And this just begs the next question, right? Even if we take that 8.2% number at face value, where is all this growth actually happening? Well, the source argues it's a tale of two economies. The growth is really firing in high-skills sectors like banking and technology. But what about the sectors that employ more than half the country, like agriculture? They're lagging way behind. So you get this picture of an economy that's booming for some, but really struggling for the vast majority. All right, let's pivot to myth number 2, this idea that a weak rupee is some kind of magic wand for India's exports.
I mean, it makes sense on paper, right? If our currency is cheaper, our stuff should be cheaper to buy, so exports should go up. But look at the data. The analysis points out that over the last decade, the rupee has fallen by more than 35%. Yet India's slice of the global export pie has been stuck completely flat at just 2%.
In fact, it gets worse. Far from booming, the source highlights that in October, exports didn't just stall, they actually fell by almost 12%. That pretty much flies in the face of the whole theory. And that gets to the heart of the matter. A cheaper currency can't help you sell more things if you're not making more things to sell. The analysis points to a slowdown in industrial production, suggesting the root of the problem isn't the price, it's that the manufacturing engine itself is sputtering. And that brings us to the third and final myth, the argument that this isn't really about a weak rupee, it's just about a super strong dollar.
You've probably heard this official line from the finance minister. The narrative is that, hey, the rupee is actually holding up just fine against other currencies around the world. It's just the US dollar that's on a tear.
But when you actually look at the data presented in the analysis, it tells a very different story. The rupee isn't just weakening against the dollar. It's weakening against a whole range of global currencies, which has made it one of the worst performers in all of Asia. So that kind of challenges the it's just a dollar problem idea.
Okay, and this is where things get really interesting.
and honestly, a little contradictory when you look at what the government is saying versus what the central bank is doing.
Get this, $34 billion. That's how much the Reserve Bank of India, the country's central bank, reportedly spent out of its foreign reserves just last year. And what were they spending it on? They were trying to strengthen the rupee to stop it from falling even further. So you have to ask the question, right? If a falling rupee is this brilliant, strategic masterstroke for the economy, why on earth is the country's own central bank spending tens of billions of dollars from its rainy day fund to fight against that very thing? It just doesn't quite add up.
So, okay, let's bring all this economic theory back down to earth. Forget the GDP numbers and export shares for a second. What does this actually mean for you and your wallet?
The bottom line is, a weaker rupee hits you directly with a higher cost of living. See, India imports a ton of stuff, from the oil that becomes your petrol to the parts inside your phone. And when the rupee falls, the price of every single one of those imports goes up. That means you're paying more at the pump, more for groceries, and it means that dream of studying abroad or taking that international vacation just got a whole lot more expensive.
So in the end, the analysis we've walked through today really leaves us at a crossroads with this big question. Is the rupee's record low just a necessary pain point, a calculated move to help the economy grow in a tough world? Or is it a flashing red light on the dashboard, signaling much deeper problems with growth and exports that we really can't afford to ignore? That's the crucial question to think about.